Hi, and welcome to the Macro Minutes for this week, 7th of April. First things first, as per usual, the information which is summarised herein does not constitute financial advice. It is general in nature and doesn't take into account your specific circumstances and should not be acted on without the full understanding of your current situation and future goals. All right, so stocks in our universe for this week. We've got QBE, JLG and RZI. We'll start off with QBE. So as of today, and this goes for the second one and John Linus Group as well, the Macro Research Department has recommended QBE. Share price is around about $9.77. I'm pretty sure most people would know about who QBE is, but just for those who don't, it's a general insurance and reinsurance company. Operates in Australia, the US, Europe, UK, and New Zealand. So look, in 2020, witnessed a sequence of pretty bad events, weather events. It was the fifth most costly year for insurance companies since 1970. So they haven't had a great run of it. And look, the likelihood of another black swan event is fairly small moving forward. Look, supporting the recovery has basically been a material improvement in the attritional claims ratio. So it's down about 3% versus the previous period. We view this as a pretty good turnaround opportunity for the insurance industry. And QBE is our top pick due to their prudent management decisions during COVID and then being very diversified geographically. Adding to this catalyst as well is the rising bond yields over the last month, which have calmed down for the moment, but they will rear their head again at some stage with all the stimulus, and once they basically just sort of start to take their foot off the QE pedal. So look, rising bond yields is good for business like QBE. They've got a big fixed income portfolio, so we're forecasting a rise in premium rates post all this recent peril. So one that's related to this is the next stock we've got here, JLG, John Linus Group, recommended today as well. Share price around $3.85, $3.86. And look, JLG it's a good pair to have. It focuses on insurance, building and restoration services, so it's about 80% of its revenue. So it will really benefit from contract work from the insurance companies in the aftermath of any of these catastrophes. JLG has about 79% of the home and contents insurance policies issued across the eastern seaboard. So, and obviously the eastern seaboard is one of the most flood fire prone regions. So it leads to comparatively higher premiums and risk for insurers. Other tailwinds include basically they've made a recent acquisition of Stamatic, Nashville, which covers a fire-prone area in California. So that just increases their geographical exposure as well. Although that was last year in January, it should be good for the company going forward. Next up, we've got RZI, Raise Capital. That's a previous rec. So essentially with this stock, they provide a funds under management update at the start of every month. So having a look back through the chart, it does seem to rally after that announcement most months, in fact at least the last 3 months, and then being a bit of a low volume stock, it does tend to peter away over the course of the month on low volume. I've been looking at that from a trading point of view. Your timing's got to be pretty good on this one. Realistically, if you want to be buying it, you probably want to be buying it towards the end of the month before these numbers come out. So the numbers this month were again a sharp incline, driven by retail funds under management growth, up about 6%. And the update was very favourable among investors. I think it rallied about 8% yesterday. And I think it's up about another 2 to 3% today. So this is this is a great stock in that micro finance area. It rounds up transactions from tap and go purchases and then puts them into an investment fund. Similar business, Acorns in the United States is a very successful business. So look, just be wary of that timing on entry or exit of that stock. And yeah, so next up, we got stocks to watch out for over the next week. We've got LYC, BOQ, and DEL. So we'll start with LYC. So LYC is the best performing stock in the ASX 200 this year, up about 60%, including dividends so far. It's a Malaysia-based company in integrated extraction and processing of rare earth metals, which basically is battery technology, lithium, essentially. It's expected to release its quarterly production update on the 13th of this month, and momentum is expected to continue. There's some fairly strong, mega trends as they call them, such as the adoption of electric vehicles, industrial automation, and obviously the ESG thematic and global climate change policy continuing to change, going towards electric as opposed to burning fossil fuels. Long term, its agreement with the US government to build a separation plant in Texas by 2025 is expected to increase yearly production by about 5,000 tonnes per annum, which is a pretty significant increase as well. So we'll watch out for that on the 13th. Next up, we've got Bank of Queensland. Now, it's scheduled to release its half-yearly results around about the 15th of April, or on the 15th of April. Its net interest margin is expected to rise by 3 basis points in the second half of 2020. Its CET1 ratio is expected to be above 10% at the end of the first half of this year, which is well above their target range of 9 to 9.5%. Look, they've also recently acquired the ME Bank for $1.3 billion. It increases their loan book by about 57%. And really does diversify them geographically into Victoria away from Queensland. So it overall is a very good move from that business. And look, they're expected to pay about a 17-cent dividend. It's about 2.8% yield, including franking credits, which is not unbelievable for a bank. But the upside growth of that acquisition and all of their numbers pointing in the right direction should bode very well for Bank of Queensland. So, and the financials, as a portion of the index, ran about 26%. We've had a technical breakup today in the ASX 200 to make a year high around about 69.40-ish. So those financials will go well as a portion of the index as we start to rally, potentially back towards 7,000 and above. So should be good for the financials. Rightio, lastly, we've got an upcoming IPO, DEL, DeLorean. It's a bioenergy company. It's going to IPO next week on the 14th. It's only a small IPO, 14 million. And it's sort of set to be the next company that renewable energy exposure to be listed on the ASX. Look, they operate in design, construction, development and operation of renewable bioenergy generation assets, specialising in anaerobic digestion process, converting organic waste into renewable electricity, heat and biomethane. That is quite a mouthful. Look, retail of energy and gas is another part of their business, and fabrication installation of industrial scale stainless steel tanks and associated infrastructure for itself and third party operators. So they utilise a bioenergy process whereby biomass products, so feedstock from agriculture and wastewater, are converted using anaerobic digestion to be used as electrical energy and fuel. This enables them to tackle and be exposed to renewable energy industry as well as the waste management sector. Both sectors going quite well at the moment. We've had a few bits and pieces of merger and acquisition movements there. Cleanaway is in the process of trying to purchase French waste management provider Suez. So that sector is relatively hot at the moment. And look, and renewables are a very hot investment sector at the moment as well. Just with the having to meet the Paris Accord, the investment in ESG assets has something roughly. I've heard figures around to meet the Paris Accord, like $8 billion a week needs to go into that industry basically to meet the Paris Accords. So renewable energy sector is very much something that a lot of fund managers are basically being forced to push money into. This business has been generating profits for 5 years, which is quite often a little bit rare for an IPO. The IPO is going to raise the capital basically for them to continue to invest in expanding their projects and their pipelines and increase their revenue streams. Their strategy's sort of continuing to execute third-party renewable contracts. Overall that's a fairly positive thing for any listing company being profitable and consistently profitable. So they did have a bit of a dip in their gross profits. I think financial year 2020 was a little bit better than their actual forecast. However, it's certainly one to watch because it might be one that really starts to take off if it gets any press. So now we're going to look ahead to the next week in terms of economic data releases. So basically tonight we got FOMC minutes. I can't imagine there'll be any surprises out of this. All the central banks have been beating a very, very clear, solid and direct message that they're going to continue QE and that rates are staying low for at least the next couple of years. And they're very happy to see inflation run before they reduce the liquidity and the stimulus. So it will be more of the same. When challenged by the bond market and 10-year yields up around 1.8, they didn't deviate from their message. So I can't see now that the bond yields have calmed down a bit, down to about 1.6 in the US. In the 10-year, I can't see them changing the message at all. It would be extraordinarily surprising. Next Tuesday we got US CPI. We don't expect there to be much, inflation pretty much in the near term. It's a problem that is down the line. Both figures are leading indicators of inflation in the US. And quite a few of the central banks now really do focus a lot on wage pressures as well. So this fear in isolation, whilst can be market moving, is probably not going to tell the entire picture as far as how the central banks are going to handle things going forward. And then just over this week as well, we've got the IMF having its semi-annual week of meetings. So World Bank representatives and central bank representatives turn up to this thing. It's not widely paid too much attention to. It's fairly retrospective. Most of the rhetoric coming out of central banks is done by the central bank themselves. I did notice last night that they did increase the growth targets or forecasts for the US fairly significantly to about 5.1% from about the high threes, I think. They also increased Australia's growth forecast as well by a good 0.8%. So, but it's really not telling us a lot more than we already know, to be honest. Jerome Powell he's going to speak on Friday morning. After FOMC minutes, we won't expect him to say too much. However, you always have to be aware of these situations. We're at a point where we start to get worried about bond yields again is around about that 2% of the 10-year. We have had the middle part of the curve, 5-year and 2-year yields increase over the last couple of weeks, probably more so than 10-year yields, which isn't necessarily. It's more about growth rather than inflation and the expectation of interest rates maybe going higher a little bit sooner than expected. But that's mainly to do with the fact that we've had extraordinarily strong payrolls numbers and up 916,000 on last Friday. And looking at Australia as well, we've had ANZ job ads up 7.4%, which really debunks the whole JobKeeper panic considering that's on the back of 8.5% rise in ANZ job ads the previous month as well. So companies are still looking to hire, even though they know JobKeeper is now ended. So we expect labour markets to continue to go quite well. So that finishes it. Thanks for attending the Maqro Minutes for this week, the 7th of April, and we shall talk again next week.